Chris Preston.
And I'm Brad Simmerman.
Welcome to Street Check, the best podcast in the history of Cabot Wealth Network. Brad, the Olympics start today. What's your excitement level? Do you have a favorite Olympic sport?
Yeah, I love the Olympics. There's all kinds of sports in
No,
it. No,
there's no gun to your head here. You don't have to say it.
no, I'm not my take on the Olympics has always been I should be a bigger fan. Like these are the best athletes in the world, like the best individual performers in the world at their respective sports. I don't really care. I ran
Wow.
track and field. I threw shot put and discus. I've done like the field events. I don't care. Um,
I'm so opposite. I don't care for 4 years, 4 years in between, but the Olympics themselves, similar to like maybe to a lesser
World
degree.
Cup.
World, yeah, kind of similar. I mean, I watched like Euro Cup and Copa America, but yeah, I generally don't watch soccer. But this is even more extreme. I pay zero attention to track and field, swimming, gymnastics. I love it all when it actually comes on. I love the next whatever, what is it, 3 weeks usually, 2.5 weeks, whatever. And the fact that it's in was Paris is what 5 6 hours 5 hours ahead. It's sad that neither of us know that, but
Eight.
it's not.
Well,
No,
we're
no,
different
it's
time
either five or
zones, so
six. It's
for
either
you,
5 or 6.
for
It's not.
you,
My point is, oh right, yeah, you're different. Never
you're
mind.
10 hours ahead for me.
That's right.
Um,
Well, it's my point is it's not in Japan or China like the last two, where it's
yeah,
like a
middle of
day
the night.
ahead and everything's spoiled for you. No, I love it. I'm ready for it to go. And my daughter is a huge into gymnastics now. So this will be the first that she's
Hmm.
able to consciously watch them. So I'm excited
Good.
for it.
You can root hard enough for the both of us.
There we go. Yeah, I've got enough patriotism. I'm Mr. Patriot.
Okay.
Enough for the both of us. Brad, tell people what we're going to talk about, not related to the Olympics today.
All right. We will talk a little bit about Chinese stocks struggling once again. Tesla reported earnings and pretty big response in the shares. Volatility is back. It's been a wild week for the market. And then after that, we're going to have Nancy Zambell on to talk real estate investing, the marketplace. She's a realtor, so she's got some boots on the ground experience with that. Before that, though, this week is your defend the take, and you will defend the take that the market will bottom before July ends, which gives you a whole 3 days. So you
Three
have 90
trading days.
seconds.
Yeah.
You have 90 seconds. You may begin.
Yeah, 3 trading days, I'll note. It's possible they already bottomed, but maybe not. We're having a good day here Friday, but start to a new week. Who knows what happens between now and then in today's news cycle, it may have lower to plumb still. So S&P, it hasn't been nothing. S&P is down 4.8% since July 16th. NASDAQ 8.8% if you go intraday since July 10th. That's over the course of 2 weeks. That's not nothing. April though is it's very similar to what happened in April. S&P down 5.5% in 3 weeks. NASDAQ 7% in just 8 days, and that wasn't trading days. 8 days. Volatility then got above 19. Right now it spiked above 18. It's pulled back a bit today. But the main thing is, and this is different from in April, the broad market, as Mike Santola likes to call it, small caps have continued up. They're actually flat during the the sell-off since July 16th, and up substantially in the last 2 weeks. Dow damage has been pretty limited, down 2-3%. Equal weight index similar. This is a tech problem. This is a AI and big tech problem. That the complaint has been that those things were driving the market, and there's too big a disparity between how those were performing versus the rest of the market. And now it's going sort of the other direction. Big tech has been a sell-off, and that's sort of what happened. There's sort of a shakeout in April. I think that's what's happening again. I think this is short-lived. I think we'll bounce back in August.
All right. We will see. We were talking about this yesterday, like just looking at charts and technicals and stuff. Right now, it very much looks like it sort of quote unquote should if we're going to bounce back, right? Like the S&P traded down to its 50-day line. The NASDAQ blew through its 50-day line. So
Yeah.
I don't know how much weight I can throw behind technicals on that, especially in earnings season. Uh, but you know, we had some like Nvidia was down to 106 yesterday and swung like 7% higher intraday.
Mhm.
Um, Tesla, which we'll get to, that I think lost as much as 20%, or in that neighborhood. So it's been wild, and earnings season always has the possibility of bringing volatility. So I mean, we'll see. It's probably too early to call the bottom, right? Like
No,
the
I'm not
biggest
calling
sin.
it, but I
No,
think
I
it,
know.
yeah, I guess I'm calling it by, what would it have to be? By no, Wednesday? Wednesday would have to be the bottom. Um, I I think a couple of things are providing a floor. It's it's a bull market. Bull market is a little over 21 months old. If it just ended up and fizzled, it would tie with the last bull market after March 2020 bottom, which was obviously a unique bear market. It would be tied with that bull market is the shortest ever. Bull markets on average last 63 months.
No,
That's one. But two, the bigger one, I think the fact that it's become almost fact. It seems almost like, prognosticators have bullied the Fed into it's, almost 100% now that they're going to cut rates at least once by September. It seems like they will, or they almost have to now. Um, I think that's providing a floor.
yeah,
Will provide a floor. 'Cause that's what people have been waiting for. And what if Fed starts to cut rates or indicates that they indeed will cut rates in the next couple of months at a time when the market is, Nasdaq has pulled back nearly 9%. What is going to fall more? I maybe it will in the next few days, but I don't see that playing out, for another month, or even weeks.
yeah. There. So just I think we can sort of consider this the transition to the big three segment about volatility being back.
Yeah.
Um, the thing that is a wild card to me that I don't have a great explanation for is the level of cash that is still sitting on the sidelines. I mean, we're still near all-time highs, even with seeing the rotation out of tech and sort of into small caps that we saw earlier in the month. It like I think we said, or we've talked about, it's like people aren't really running for the exits, but it also looks like people aren't super excited to deploy more capital, even when it comes to expanding, or even when it comes to adding exposure to like small caps and value stocks and real estate investments, which we'll talk about when Nancy comes on.
Right.
So I don't know if maybe the catalyst is a lower yield on cash, right? Because right now you can get 5% on cash, and that puts you like what 80% towards what your annualized return probably should be if you're a big institutional investor and you're targeting like 7% a
Right.
year. So if it's already doing 80% of the work, you don't really have a huge motivation to deploy that fresh capital. Maybe once we get further into that rate cutting cycle and cash starts yielding 4.5%, 4%, high threes, right? Like sometime next year. Maybe that's the catalyst that takes the money off the sideline, but that's a little bit of a wild card for me. I would think people would be maybe more eager to deploy cash and just I haven't seen it.
Yeah. Um, yeah. I mean, I honestly, I view that sort of as a positive that it's still out there.
Yeah,
Yeah, the run up in small caps just started, what, 2 weeks ago, a little over 2 weeks ago. Um, you know, uh, I think the other parts of the market, other large caps have gotten swallowed up a bit by the tech pullback. We're seeing uh, with the S&P down 5%, that's not all, the same 10 stocks that drove the market higher. It's broader than that. There's been a lot of tech
right.
blowups as earnings season has happened. Um, so I think, it could be biding, that money could be biding its time a bit. Still, uh, that I think there's a little bit of a believe it when they see it sort of aspect, and they
Sure.
they've yet to see the boat rowing with all the oars at the same time yet in this bull market after 21 months, other than maybe last November, December, but that was, pretty short lived.
Yeah, I agree with you that it's a net positive that there's still a bunch of cash on the sideline. Like that's market moving cash that's out there, and if
Yeah.
you're in the right spot, you can really ride that wave. And the thing I'm wondering is just it's like, okay, well, what are you waiting for, right?
Yeah.
Um, that
Maybe
so
the election.
maybe, I mean, maybe it could be as simple as
Maybe rate cuts. There's two huge
yeah,
potential catalysts we've been talking about for over a
over to
year.
2 years, yeah,
2 years? Yeah. When will the Fed start cutting rates? I mean, I guess the Fed rate hikes peaked. I think it was last July, right?
June or
Last,
July, somewhere around there, yeah.
yeah. So like the cut portion of the discussion maybe started after they held the next month. So maybe a year at most. Election, yeah. I mean, probably. Well, this is a different phase of that discussion. I I wonder how much. We don't have to get into it today. I
Well,
wonder
and
the
I mean,
fact
we
that
are,
it was going to be Biden Trump, which is two knowns for better or worse
yeah.
for a while, and now it's not only an unknown quantity in Harris, but one that's occurring at an unknown time, like how someone entering the race 4 months before the election impacts things, something we haven't seen. I think even like the latest incumbent to exit who was eligible for reelection, I think was Lyndon Johnson, and that was even in
Yeah.
March. That was March, so it's something
Yeah.
we haven't really seen.
And we're in the summer. Wall Street tends to take long summer vacations. There's a reason they say sell in May and go away. So like, okay, so everybody gets back from the Hamptons in end of
Yeah,
August, beginning of September, and then you've got the election you're staring down the barrel of an election in the beginning of November.
right.
If I'm an institutional investor, I'm worried about that. I'm probably like, all right, well, we're not going to dive headfirst into things. Let's see how this election shakes out and get a better sense of what the next couple of years hold.
Right.
So,
And the
maybe that
pattern
cash.
is that the last few elections that stocks go up after the election, regardless of which party wins.
Plus, that's the opportunity to wait for the Fed cuts to actually kick in instead of
Right.
having people just speculate about it. So maybe we
Right.
just stay a little bit choppy and sort of cash on the sidelines until
Yeah.
into the fall.
Yeah. I can see that. Number two, you mentioned Tesla reported earnings that bombed yet again. This is the fourth straight miss, but the second straight like true bomb. I mean, net income fell 45% year over year. Um, global vehicle sales tumbled, so it's not just Tesla. Revenue was up 2%, but when your profits are down 45%, that's not something anyone wants to see, and thus Tesla has fallen pretty sharply. It was living in the 170s for like a couple months,
Yeah.
waiting for any catalyst, and then it exploded to the upside in a big way after deliveries came in slightly ahead of expectations, second quarter deliveries, and that got reported at end of June. So it went up from 170s, maybe around 180, to as high as 263 on July 10th, which was the top for the Nasdaq. And then combination of pullback in big tech and then earnings, sort of that double whammy, it's down to 216. Now that's still in the aggregate, it's up in the last uh, month, and up a lot in the last 6 weeks, but the trend is bad. No amount of Elon Musk tweeting can cover up a 45% pullback in net income.
Did they or did you see anything about what the full self-driving adoption numbers looked like? It just occurred to me that I didn't try and pull that because they had rolled out that promotion where it
Yeah.
was like free full self-driving for a month. That seems like a pretty immediate revenue booster if that's a success because there's no anybody that's eligible for it, it's just a software update, right? And then that's essentially pure profit for Tesla. But if that kind of fell flat, then that just lends itself to the miss.
Just said it. He said on the conference call, Musk did, full self-driving system should be able to run without human supervision by the end of this year.
Well,
Uh, Although he acknowledged that his predictions have been overly optimistic in the past. So probably not the end of the year.
Yeah,
Yeah.
there's and I know there's been a lot of discussion with the Optimus and with Robotaxi, which was supposed to come in August, but I guess got kicked to October, or was supposed to come in October and got kicked out further. Um, I think there's probably some investor fatigue with
Yeah.
unfulfilled promises. Um, the boring tunnel with the Hyperloop, right? Like we saw the Hyperloop. We've had years now of full self-driving becoming like the automation software on the road, and that sort of hasn't panned out. Um, there's probably some shareholder fatigue. Like people overlook those kinds of things when the stock is skyrocketing, but
Hmm.
if it's just moving laterally or if it's just sitting in a range, people start to get a little antsy and look around and say like, okay, well, what's the next thing that's coming that's going to drive these shares higher? And I wonder if you're maybe just losing some investor enthusiasm there. Plus all
Yeah.
the tweeting and
Yeah.
like all that stuff hurts his core demographic or
It
turns off
does.
his core demo.
Yeah. No, I mean, the less he says, I think the better these days, but he can't help
Are
himself, especially with an election coming up.
are you in a different spot? Because we talked about Tesla a couple of months ago. Are you in a different spot with like the buy sell hold than you were then? Because I'm looking at
So,
it and I'm feeling
okay.
about the same.
So, um, I can just say this. I think Tesla is the longest standing holding in any Cabot portfolio. It's the happens to be in the one that I run or took over a couple of years ago, stock of the week, which selects the best stocks from that our other analysts pick in their other newsletter in their newsletters. We recommended Tesla in um, December 2011 when it was on a split adjusted basis trading at $2 a share.
Yeah.
So people made a lot of money on Tesla through us. It's still in the portfolio. It was a hold almost all year until the late June, early. I guess I switched it to a buy 2 weeks ago, 3 weeks ago, because it was way up. Now, I guess you can make the argument that after this pullback, the pullback has been enough that it's a good time to buy, and I probably will leave it at a buy.
Yeah.
But there's no denying that the investor enthusiasm for Tesla has waned.
Yeah. Yeah. I I agree. I don't know. If you're a long-term holder of it, keep holding. Your net position, you're up 25-30% in the last 2 months or so, right? Like it doesn't really matter if you're a shareholder what Elon Musk tweets if you're up 30% in 2 months.
Right.
Um,
Yeah. I think those things hurt in the short. Well, it's funny. They hurt from a perception standpoint, and they hurt in the short term. Like Musk said this today, stock down 2%, that kind of
yeah.
thing. But all those sort of like death by a thousand cuts kind of thing. Like people are, there might be some Tesla and more importantly Elon Musk fatigue. Does that mean the company can't rebound after whatever's happening to electric vehicles? The electric vehicle enthusiasm, buying enthusiasm, is certainly waned. We've talked about the power of that sort of shifted to hybrids. Um, I wonder if they would ever launch a hybrid. Probably not. But until that passes, Tesla might have a hard time getting going.
No.
Um,
Let's
okay,
talk China.
yeah, let's talk China.
So you told me that that Carl Delfeld, Cabot Explorer's chief analyst, had an interesting take on China, which the stocks have been sort of struggling a little bit. There's concerns about China's economic strength. There's concerns about tariffs on Chinese goods and chip export restrictions and things like that. What was Carl's take on it?
Carl, citing some of the things we've talked about in the past, struggling market, but also 20% youth unemployment, property slump, weak consumption by its standards. It might be on the cusp of what he's calling a balance, or maybe not his term, but balance sheet recession.
Mhm.
Sorry, he's saying it's expression coined by renowned economist Richard Koo to previously described Japan, when Japan's households and businesses prioritized debt repayment and pulled back on consumer spending and investment. So that has led to that hurt Japan for years, and he's saying that it could be something similar with China. I'm a little skeptical of that, but um, he's saying that it makes sense to shift elsewhere if you're looking overseas right now. And Japan and India were the two countries he mentioned. Japan has a lot of momentum right now, and Carl's high on India, um, uh, which its economy is held up a little bit better, at least on a relative basis. And he also said he's big into frontier markets. He he cites the AFC Asia Frontier Fund, but that's unlisted, so probably not a whole lot of help to people.
Yeah.
Vietnam, he lists their exports are surging and now are 83% of its economy. So those are the three countries he mentioned specifically: Japan, India, Vietnam, as alternatives.
Yeah, yeah. I like India sort of academically makes sense to me, right?
Yeah.
If the US if we keep moving at a torrential pace, then sort of good for the global economy. If we slow down a little bit and companies are in cost saving mode, it's probably a net benefit for Indian employment. They're a beneficiary of a lot of our job outsourcing that we've been doing. I know tech industry wide has been going through a bunch of layoffs right now that do seem to be finding their way to the Indian markets.
Mm-hmm.
Um, y- I don't know.
Their economy expanded 7.8% in the first quarter.
Yeah, it's fast growth. A lot of the emerging markets have been sort of in that same small cap environment for a couple of years where it's like they haven't really been outperforming the way that you would expect them to historically. So there's
Yeah.
probably an unloved element where you can get some catch up growth, not catch up
Yeah.
growth.
No,
That
we'll save that for a different episode. Yeah.
uh, so I see the opportunity there, and especially if the majority of what we're invested in is big tech, I think you can make a case along the same lines as we have with small caps, where it's like, hey, this is an unloved asset class. You take some profits out of big tech and diversify your portfolio a little bit,
Yeah.
and you know get disconnected from the U.S. economy a bit, uh, but obviously not fully. So
Yeah. India's growth is compelling, and the fact that it's sort of the next in line superpower behind China. If China really falters here and does become like another, what Japan had been for
yeah,
decades, India, you know, could easily swoop in and take the reins. Especially, it's growing similar to what made China sort of the envy of, at least among emerging market economies, for years really prior to the pandemic. So yeah, I think that's a good play. Japan, I like that Japan finally has gotten its act together and the market has momentum. I just want there's so many decades of just stagnation. It's hard to fully go all in with Japan, especially with the market at new highs, after just whatever it's been, a year or less than a year. I think
yeah.
India is a little more powerful.
I remember reading that one of the sort of common talking points was Japan got to the 90s first, but then just stayed there.
Yep.
So,
Right.
I don't know what the impetus is for major growth other than foreign capital coming in.
Yeah.
Um, I don't know. It's not a bad thing though if you've just got like solid economic growth that's not super high flying. Like that seems like a
Yeah.
pretty safe angle to take on international expansion or
Yeah.
expanding your portfolio internationally, I should say,
Yeah.
is like it is Japan the Campbell's Foods of international
Right.
investments.
Right. And that said, I wouldn't totally dismiss China either. I've been I think we've both been high on China as sort of a contrarian play. And maybe this pullback's a buying
Yeah.
opportunity in certain Chinese stocks that you like. Um, okay, so let's bring on our guest for today, Nancy Zambell, and we'll bring her on in just a second. Welcome on Nancy Zambell, who is chief analyst of Cabot Stock of the Month, editor in chief, Cabot Money Club. Nancy, housing is sort of, as a real estate realtor yourself, housing is sort of, your wheelhouse, and housing has been one of the few areas of the market the last couple of weeks that have actually, well, that and small caps, that have actually been up and up substantially. What do you think? Because that was not the case for a month prior to that. What do you think flipped it? Is it just that it feels now 100% basically the Fed's going to start cutting rates in September, by September?
Well, I just looked at the new statistics last night and they are up somewhat, but really at a slower pace. I mean, existing home sales actually slowed in June at the slowest level since 2010, to 3.89 million versus 4.11 million a year ago. New home sales also slowed 617,000 versus 621,000. Housing starts are a little higher and building permits are a little higher. But we're seeing on a local level, no pickup. It's
Really?
been, yeah, very, very slow. Interest rates are running around 6.8, 6.9% for the 30-year mortgage rate right now. We are getting houses staying on the market longer. On national level, the days on the market are almost 5 months now, which is a pretty significant amount higher than what it's been since pre-COVID. And on a local level, our days in inventory definitely smaller, although they've doubled since last year. And I had a client say to me yesterday, she wanted to put her house up for sale and buy another place. And she says, well, my house should sell very fast. I said, don't know about that. I think what's happening is we're going back to the pre-COVID housing market, which was what I would call the normal market, where sometimes houses stayed on the market for a year or two. And I hate to tell sellers that, but that's what it is. I mean, we've definitely increased our inventory tremendously in the last few months, actually since the first of the year. Yeah, we're not seeing any great moves in the housing market. And
Yeah, it makes it interesting.
Go ahead.
I was saying it makes it interesting that the ITB, is up 21% in the last 3 weeks. It seems like that might just be purely, forward looking. It's
Yeah.
not responding to something that's happening yet.
Right, and maybe temporary. Most of the economists are
Right.
saying that the mortgage rates might decline by 2% next year, which would still make them close to 5%, which historically is not that much, but in recent times, that's high.
Right.
Yeah. I have seen that a lot of the new build. So I think maybe part of the disconnect is a lot of the new builders are offering, rate promotions, rate oriented promotions and stuff. So I think their sales, they've been able to sustain a little bit better than existing home sales have been. Is
Yes,
that? Oh, go ahead.
and the pricing of the new homes is pretty close to the pricing of existing homes, which doesn't always happen. In a really good market, new homes are a lot higher just because people want new and they're willing to pay up for it. That difference has narrowed substantially in the last year. But so if you've got the choice, new home, 30-year-old home, you're priced at about the same amount, which is somewhere between $250 and $325 a square foot in our market. What are you going to choose? New home, probably, right?
No. So is that something that would be, I guess, feasibly enough of a buffer for new home builders where we could keep seeing outperformance for the home builders, at least from an equity market standpoint?
Well, I mean, maybe. I mean, right now, as I said, housing starts and building permits have edged up just a little bit, and the builders are doing these rate configurations, which they call buy downs in the market, to encourage people to come in. But those buy downs are temporary. They're 1 to 3 years generally, and people still have to qualify at the existing rate. They can't qualify at that lower buy down rate. So I'm not sure. I think that we're going back to a normal market, so that makes me kind of maybe depressed about housing stocks and REITs too. I think once we start getting some rate cuts, that will give at least a temporary boost to the market. But I think people are going to have to understand that, yeah, we're going to probably go back to normal now. People are not going to be getting 25% more for their house than the listing price. That stuff is ended.
So how long are you expecting for it to sort of click with sellers that they actually might have to consider cutting their sales prices?
Well, they're
Uh,
slow to react, and
yeah.
they really got used to having those, oh, well, I'll list it at $4.99, but I'm sure I can get $5.50 for it. So people are still thinking that, just like the client that I talked to yesterday. I think it's going to take a while for them to understand. And the other thing that's going on, and I think we may have touched on this before, is the changes with the National Association of Realtors and the way the commissions are paid. So now we actually got new forms in as of Wednesday, and they basically say that the seller doesn't have to pay the whole compensation to the realtors now, that the buyers can also be made to pay. That is also slowing the market because buyers typically don't have any extra money. They've got enough money for the down payment, and they have enough money for the closing costs. Now we're going to charge them another 3% maybe on the housing price. So it's going to take a while for that to juggle out. Regions of the country that have been doing that already for a while say it's temporary. It causes discord temporarily, but after a year or so, things sort of settle down. And what will probably happen, and what has happened in those areas, is that it's gone back basically to the old way, that the sellers still pay the compensation. It's always been built into the price of the house. So it just has to work its way through the economy, but that's causing buyers to be very reticent. Guess as of August 17th, the whole seller deal is going to go away, and the buyers are probably going to be expected to pay part of the compensation.
So if you are, let's say, producer Madison right now, who's interested in probably buying a house in the next couple of years, interest rates look like they're probably going to come down on mortgages next year. Buyers are going to start having to take discounts probably next year. If you're not buying a new build, are you probably coaching buyers to maybe wait until 2025 to take the plunge, because you'll likely have lower rates and you should hopefully get better deals on stuff? Or is
Well,
this
not
still
really.
a love the home and marry the
Yeah.
house and date the rate?
Well, there's a couple different options they can have, is that they can think that, well, a refinance will be in their future, which is what happens every time rates go down about 2%, people just start refinancing wholesale. So you could say, okay, you may have to live with this rate for a year, so higher house payments for a year. And the difference between 2%, I did some numbers based on the average housing price, which right now nationally, or the median housing price is, 426,900. And if you looked at that and you did a 30-year mortgage with 10% down today, your payment would be $2,852. If you say a year from now and rates are 2% less, it's going to be $2,363, almost $500 a month. That's significant for most people. So, I mean, you can say that. You can also, people can do their own buy downs if they've got enough cash. They can just say, okay, the first couple of years, I'd like to have a 1% less than what the average rate is. You can also do an adjustable rate mortgage, though the difference between adjustable and fixed rates, the rates really aren't that great compared to what they used to be, which is kind of surprising.
Yeah, that's really interesting. Shifting to the market, it sounds like you're not maybe that high on housing related stocks at the moment. Is there, given how volatile the last couple of weeks have been, is there a sector or areas that you like right now in particular?
Well, I was just, in fact, let me just take a peek, and I'm going to pull my newsletter up here from this last one. But I was really into finance stocks, and then they started doing a little bit better. So I'm not as hot on those today as what I was.
Are you getting interested in small caps, given what?
Yeah, I'm definitely getting interested in small set caps, and I know that they had a pretty good day yesterday. So I think like the stuff that Tyler is recommending right now is probably pretty interesting. And some of Mike's trading stocks, particularly in Cabot Top 10 Trader, those would be all things that I would be interested in. But yeah, the biotech sector, that's kind of a crapshoot if you don't know anything about it, but that's always a hot sector. Communication services have done really, really well. I actually sold out of some of that in our newsletter last month. Technology has come back again. I'm always a fan of technology. I don't think we're doing the whole recession thing again, so I would probably
No.
be more interested in consumer discretionary stocks than consumer staples. And those have only, they've only gone up 1% so far this year. So I think that that might be an interesting, some of the luxury goods this morning on CNBC, they were interviewing the CEO of Louis Vuitton. I don't know if you saw that. Well, whatever it is, LMVH or something
Yeah,
like
LMB.
that now.
Yeah.
Yeah. And so
Yeah.
that was kind of interesting. Of course, they basically own the whole luxury market right now.
Yeah. And in terms of, I know you track sentiment, investor sentiment closely, and that had been pretty bullish, what, 2, 3 weeks ago? Has it flipped at all in the last couple of weeks?
Well, not really flipped. I think it's kind of receded a little bit. So
Receded,
not as bullish as it was, but it certainly isn't bearish by any stretch of the imagination.
Right. And that's what you
Yeah.
want. You want bullish, but not too bullish. It
Right.
seemed like we had maybe reached too bullish a couple of weeks ago.
Right,
In fact,
right.
I don't know if I mentioned this to you. We had analyst roundtable with a few other Cabot analysts joined us just exactly 2 weeks ago, right when the market was at highs, and all 6 of us were bullish, and we were like, I think
Yeah.
Tom Hutchinson, who's usually not, he said he had been bullied into bullishness. But we all at the very, and Brad is a little reluctant to be bullish at times too. And we all at the end were like, I don't know if this is a good thing. We're all so bullish.
Yeah, it's kind of a contraindication. It's like when all of the consumers get bullish on the market, time to head out.
I know. Sure enough, yeah, I think we realized this sharp pullback was coming by the end of that episode. Brad, you had something.
Yeah, no, I mean, it very much feels like we're in that sort of wall of worry environment that a lot of investors, especially Michael Brush, he likes to share data on the investor sentiment and that wall of worry, where we were maybe getting a little bit overheated into July, and then market ran into some trouble, and we just seemed to pull back. Does this still feeling like a healthy bull market to you, Nancy? I know you said probably no recession. Does it still feel like a healthy bull to you?
Well, it still feels like a bull. Healthy. I don't know about healthy. I
Yeah.
think it's still very much a stock picker's market. And I
Yep.
think it's going to be that way until after the election. I mean, I did an article for the Daily if or so ago about only what happens with elections and Democrats versus Republicans. And it really doesn't make a hill of beans worth of difference what political party is in
Right.
the office on a long-term basis. So people get all wild about that stuff, and they think, oh, the world's going to hell in a handbasket if this person gets elected, and it's going to be great if this one. It doesn't really make any difference. It's really the economy stupid, right? So it's
Right.
whatever the economy is doing and what earnings are doing. Earnings have been mixed so far. We're early in the earnings season, and of course, we've had some really great earnings quarters lately, for the last few years. And so we're starting to see a little mix. The analysts work, as you know, very closely with the companies to try to make sure that their expectations and their estimates are right on track. So when they miss a little bit, that's always a question in my mind. What is exactly going on here? What sectors are going to do well? So I think that, they've had a really good run. I wouldn't be surprised to start seeing earnings pull back a little bit instead of growing double digits all over the place. And if they do that, that tells me the stock market's probably going to pull back a little bit too. But again, this is all, I don't have a crystal ball. Like Mike always says, I have no crystal ball.
The Cabot line.
Yeah, but I just think that, you don't want to go wholesale into any one sector or any one style, whether it's growth value, whether it's small caps, whatever. You always keep some of your powder dry, always be diversified, and, have a little bitty part of your portfolio that you can just go for the 10 baggers, but that's not what your whole portfolio should be.
So
And
one
it's
last thing on the stock picker market of it all. We are in the midst of earnings season. If you have an individual name that you're looking at, are you waiting until after earnings to buy?
I typically do, just because it can fluctuate. And if they miss by a penny or two, but I still think that the stock is sound fundamentally, then that's a good time to buy it. It's important to do your evaluation of a company based on whether or not you think it's fundamentally strong, but you also have to say, well, when should I buy and sell it, right? Because you could have the best company in the world. If nobody else is interested in buying it, the price is not going to go up. And if everybody decides to sell it like some of the funds do, you know, with the herd mentality, when one fund or one analyst sells, everybody else on Wall Street sells, and that can just kill your stock. But those earnings things, those are temporary blips. It's just like declaring a special dividend. I like to buy those kind of stocks that declare special dividends, and usually I'm out of them pretty quickly once the stock goes up. So yeah, so you have to really worry about that. But yeah, to answer your question, I probably would wait until after earnings were announced.
Last thing, so as we mentioned, you run the monthly Cabot Stock of the Month issue, in addition to a Cabot Money Club. I think you released your latest issue today.
The magazine today.
Just for people, so I highly recommend people subscribe. You can go to the cabotwealth.com website under premium advisories. You can find you can learn how to subscribe there. Tell people what just sort of the general theme of today's issue is, or this month's issue.
Okay, so the magazine issue came out this morning, and I thought it was time to just talk about ETFs, because the stock market, you know, picking stocks is not for the timid. Most of us do that fairly well, but for an individual investor, especially someone who's getting started, which is sort of my target audience is the newer investor, ETFs are a great way to go. You have a lot more to choose from if you're in a 401k. So I basically just talked about ETFs, the difference between funds, and then I showed several different portfolios set up for people based on age and also based on their risk tolerance. And we shared with them an investor's quiz that I wrote many, many years ago to try to determine what your risk tolerance is. I mean, because people really don't know. They think that they're an aggressive investor, and they're not at all. And once they take that quiz, they're like, oh yeah, I don't really want to lose 30% overnight. I can't sleep. So I am not an aggressive investor. So it's one of those things that your portfolio should never be set in stone. I am a real big believer in people monitoring their portfolio at least on a quarterly basis, even their ETFs, because sectors do change and your age changes the way that you invest. How much money you have changes the way that you invest. So it's one of those things that, you know, most people need a little advice with it. But what I did in the magazine today is just give you some sample portfolios using, by the way, the stocks and the ETFs that are in my Cabot Stock of the Month newsletter.
Sounds great. Again, people who want to read it, you can go to the cabotwealth.com website under premium advisories. It's Cabot Money Club and Cabot Stock of the Week. Nancy, thanks so much as always for joining us. And thanks everyone for joining this week's episode of Street Check.
Thanks for having me.